The oil market maintains a fragile equilibrium in a world where international relations are precariously balanced, global economies are teetering on the precipice of instability, and commerce pulses through every nook and cranny of the planet. Today, we travel to the core of this dynamic energy environment, where the titanic OPEC has just changed the rules of the game, upending the very foundations of the world's crude oil prices. Oil prices danced a little on Monday in the world of black gold, propelled by a dynamic duet of forces. First, it was anticipated that OPEC Plus will stick to its keep-it-tight stance. Second, there was a lot of talk about the U.S. Federal Reserve perhaps slowing down its rash of interest rate increases. Let's now focus our attention on Saudi Arabia, the oil-producing nation that has been acting as the oil price rescuer. They have been swinging the knife, voluntarily reducing output significantly as part of the OPEC Plus Accord, a supergroup of oil-producing nations that includes OPEC and allies like Russia. And what's this? With an eye toward October, Saudi Arabia is preparing to extend its voluntary 1 million barrel per day decrease for a fourth month in a row. Oh, and just a warning, Saudi Arabia typically releases these pearls of knowledge prior to announcing their official selling prices, which are akin to their monthly oil report card. Speaking of numbers, Saudi Arabia's oil exports fell slightly in August 2023, from 206.61 million barrels to 175.22 million barrels, compared to the previous month's 206.61 million barrels. Back in July, Saudi Arabia made the decision to engage in some oil slimming activities, further reducing their production by 1.5 million BPD. The worst part is that, according to a recent Bloomberg article, shipments from the kingdom in August plummeted to just 5.6 million BPD, reaching levels not seen since March 2021. The UAE, meanwhile, made the decision to proceed rather differently. According to data from Refinitiv, they increased their oil exports in August compared to July, exporting 91.67 million barrels as opposed to the 85.13 million barrels they said goodbye to in the previous month. Iraq, including Kirkuk, marginally underperformed July's numbers, producing 110.76 million barrels in August as opposed to 111.39 million barrels in July. Aside from that, there are some intriguing twists in store. Alexander Novak, the Deputy Prime Minister of Russia, recently revealed that export restrictions would be maintained through October. Although Saudi Arabia and Russia have the option to reverse these cuts at any time, it doesn't appear probable that they'll do so quickly and risk another price decline, as predicted by Oanda analyst Craig Erlam. Looking at the data, U.S. West Texas Intermediate Crude, WTI, October futures witnessed an increase of 40 cents, closing at $85.95, while Brent crude futures for November saw a slight increase of 45 cents, settling at $89 a barrel. On the supply side of the equation, improvements in crude oil supplies are anticipated over the ensuing 6 to 8 weeks as a result of planned refinery maintenance. However, as noted by Russell Hardy, CEO of Vitol, the largest independent oil trader in the world, sour crude is anticipated to continue in short supply. According to a senior executive at the international commodities trading company Trafigura, there is a vulnerability in the oil market that is principally caused by low inventories and underinvestment in new oil fields. Moving on to the economic front, recent U.S. August jobs figures have increased hopes that the Federal Reserve may temporarily halt interest rate increases. Positive news came out of China as factory activity surprisingly increased in August. Optimism for rising demand in the top oil importer in the world has been prompted by a series of economic initiatives aimed at accelerating the nation's post-pandemic recovery. John Evans at oil trader PVM observes that the market seems to be more receptive and less skeptical right now, which is a surprising but somewhat refreshing turn of events. This change in attitude may be the result of Chinese leader Xi Jinping's pledges to assist the services industry and loosen trade restrictions, which resonated with a market lacking the normal input from U.S. participants at the time. Reuters recently received some perspective from Acme Investment Advisors Executive Vice President and Chief Strategist, Sugandha Sachdeva. She stated that the prospect of more supply cuts from major oil-producing nations like Saudi Arabia and Russia has been the primary factor driving the volatility in crude oil prices. While this expectation has driven up prices, Sachdeva emphasized that it's important to monitor the gradually rising oil production in the United States. A big price increase might be restrained by the rising production. Last week, Russian Deputy Prime Minister Alexander Novak announced that his country and its counterparts in the Organization of the Petroleum Exporting Countries had achieved an agreement on the parameters of ongoing export restrictions. What is now approaching? Well, OPEC Plus will probably make a formal announcement regarding these anticipated cuts this week. Following a significant 500,000 BPD cut in August, Russia had earlier announced a reduction of 300,000 barrels per day in exports for September. Additionally, it is anticipated that Saudi Arabia will decrease its shipments by 1 million BPD in October. Let's discuss some other variables that may have contributed to the recent changes in crude oil prices. This time, we'll focus on the fascinating interaction between China and the United States. First, August brought a little bit of a surprise for the Chinese manufacturing industry. Data from Caixin's manufacturing PMI survey showed an unexpected increase. Since China is the biggest oil importer in the world, this unexpected surge has given rise to a new wave of confidence. Positive news from a significant player like China can cause repercussions in the oil market. There are now job-related developments in the United States, which is over the water. Last Friday's employment report was more positive than expected, with a gain of 187,000 jobs in the non-farm sector for the previous month. There is a twist in this story, though. Although job growth is still occurring, it has slowed down a little. Analysts now think that the Federal Reserve may not be as eager to raise interest rates as previously expected due to the slowdown in employment creation. Nearly every element of our economy and world politics has been impacted by the sharp increase in crude oil prices worldwide. These increased prices have an impact on a variety of areas, including government finances, consumer spending, inflation, and corporate operations. For regular people, the effects are felt immediately when fuel and energy prices rise, potentially triggering an increase in inflation and reducing our discretionary expenditure. Businesses are struggling with rising operational costs, regardless of their industry. As a result of their attempts to adjust to the changing economic landscape, this can reduce profit margins and, in some situations, even result in job layoffs. Geopolitical tensions in significant oil-producing regions are another factor. These conflicts may intensify already erratic price swings, causing a reverberation throughout international markets. Furthermore, there is a benefit to the higher oil prices because they encourage investment in other energy sources, ushering in a new era of energy innovation. According to a report published this week by Vortexa, global loadings of oil and condensate fell to their lowest level in August since June 2022, driven mostly by a decline in Saudi Arabia's cargo loadings. According to Vortexa, the global supply is contracting while China's imports of oil are increasing. According to Jay Maru, head of Market Intelligence and Analysis, MENA, at Vortexa, this combination of tighter supply and increasing demand is likely to persist through the end of this year and support pricing, especially given the recent extension to Saudi Arabia's voluntary production cuts amid a general uptick in global refinery runs. The voluntary production cut of 1 million barrels per day, BPD, by Saudi Arabia was extended last week through December. Both Brent and WTI oil prices were moved above the $90 per barrel this week, and front-month futures are expected to post gains for a third consecutive week. The lowest level since June 2022, as measured by Vortexa data, was reached in August by loadings of roughly 47 million BPD of petroleum and condensate from Saudi Arabia. According to Vortexa's Maru, the decline in Saudi loadings means that the kingdom's contribution to total global seaborne flows is at a multi-year low. This decrease supports Saudi Arabia's voluntary production cut commitment, but the key question is how sustainable this is, said the report. Following a decline in global oil arrivals in July, China received roughly 1.3 million BPD more petroleum in August compared to July, for a total of almost 13 million BPD, per Vortexa's data. According to Vortexa last week, the market hasn't yet fully absorbed the effects of Saudi Arabia's additional production cut, which might result in a significantly tighter market if the top crude oil producer in the world maintains low export levels. What are your thoughts on Saudi Arabia and OPEC+, and do you think they can overthrow the US economy? Let me know down below. If you want to continue to learn about business investing and financial education, we have got this video waiting on the screen for you to check out. Don't forget to give this video a like and subscribe for more videos like this. Thank you so much for watching, and I'll see you in the next one.